Good afternoon, and welcome to Coffee and Conversation with the Experts. My name is Mark Hill. I'm Chief Policy Officer of the Nashville Area Chamber of Commerce, and today's topic is implementing the Affordable Care Act. What businesses need to know today about Obamacare. Today we're going to set the politics aside and focus on the questions that businesses need to have answered about this very complex issue. I want to start by saying a special thanks to our presenting sponsor, Jackson Hewitt. Jackson Hewitt Tax Service provides a full range of individual tax preparation services, and they will complete for customers the government paperwork to enroll in the ACA at no cost. In addition to Jackson Hewitt, we'd like to recognize the sponsors that make today's event and all the Chamber's events possible. Thank you to our pivotal partners. This is a partnership at the highest level of the Chamber for our programs and events. Our pivotal partners are Delek U.S. Holdings, Blue Cross Blue Shield of Tennessee, Community Health Systems, First Tennessee, and Atiba. Thank you also to our Friends of the Chamber sponsors, Bradley Arent Bolt Cummings and Mission Point Health Partners. And finally, thanks to today's supporting sponsor, the Hendersonville Area Chamber of Commerce. Earlier this year, the Hendersonville Chamber and the Nashville Chamber formed an advocacy partnership around our state legislative action. And so Hendersonville Chambers are able to attend today's event free as part of that advocacy partnership. To begin today's program, I'd like to ask Brian Hale, who is Senior Vice President for Healthcare Policy with Jackson Hewitt Tax Service, to bring us up to speed on the current status of the Affordable Care Act. And Brian, please also take a few words of welcome on behalf of Jackson Hewitt as today's presenting sponsor.
Well, folks, thank you, and thank you for making time to come out to talk about one of the most interesting policy areas that all of us are facing, whether we want to or not. We're in the midst of the rollout of the Affordable Care Act. So what I would like to do or propose to do is for the next 5 minutes just to sort of level set and provide a little bit of background and context for some of the Affordable Care Act programs that the panel will be talking about as we move through today. So just to sort of set the groundwork for what we're going to be discussing today, the Affordable Care Act really has a couple of provisions that are most important to you. In a number of states, the state will expand Medicaid, and that may include Tennessee as we move into the next year. If the state does expand Medicaid, that means that everyone under a certain income level will have access to Medicaid coverage for free or for very low cost premiums. Above the Medicaid income group are really the tax credit programs. And those programs are available for people who have incomes between 1% and 400% of the poverty level. We'll talk about what exactly those income thresholds are in a moment, but the key point to remember about the tax credit program is that you're eligible for the tax credits if you don't have an offer of affordable coverage through your job. And the last piece that's really important probably to you is the individual market reforms. What's really the redemption of the individual market in the sense that anyone can buy coverage regardless of their prior health history or whether they have ongoing medical conditions. So who's eligible for what? Well, in the Medicaid program, we use the typical 5-finger test. If you're aged, blind, permanently disabled, a pregnant adult or parenting adult, or a minor child, you may be eligible for TennCare or the state Medicaid program if your income is below a certain income limit. Again, just to remind you, the 5-finger test is aged, blind, disabled, pregnant or parenting adult, or minor child. Now, if the state expands the Medicaid program beyond the 5-finger test, it covers everyone below a certain income threshold. But even if the state doesn't expand, you still have individuals on the 5-finger test that will be eligible. You'll also have the tax credit programs, but again, those are only available to people if your income is above 100% of the poverty level, below 400% of the poverty level, and if you do not have access to affordable coverage through your job. Now, I've been referencing the poverty level, so just to sort of put this in perspective, I've got a table up on the screen right here, which sort of illustrates exactly what we're looking at. Someone who is below 400% of the poverty level is a single individual who makes $45,960 or less, or for a family of 4 making $94,200 or less. Now, both of those are above the median household income for our state, and the latter is more than twice the median household income for Tennesseans. So when we think who may be eligible for these programs, it's pretty obvious it's even middle-income Tennesseans, again, provided that they don't have affordable coverage through their job. We mentioned a moment ago the redemption of the individual market. Here in gory detail are all of the changes that happened, and you'll notice that the column that describes the insurance market today is very different than the column that describes what it will look like on January 1st of 2014. It's not really important to go through the details here, but what you can see is a lot of transition, which explains why so many Tennesseans are receiving cancellation notices because their policies are not compliant if they're in the individual market. It also explains some of the changes that you're seeing if you provide health insurance and the costs that you'll incur if you continue to provide that coverage in and after 2014. And that really gets to the kernel of the decision that you may be facing. Should you continue to provide coverage? And that's an open question. But the things that you'll want to think about, at least as you look at whether or not you continue or you provide coverage, or do you meet the minimum value criteria? Are your deductibles sufficiently low? Specifically then with respect to deductibles, are your deductibles compliant with the new maximum thresholds under the Affordable Care Act of $2,000 for single individuals, $4,000 for families? And the last piece is really affordability. To what extent is the employee-only premium that you charge your employees really affordable? If your plans are not affordable, as defined by the IRS as being less than 9.5% of the employee's gross income, or if your policy does not meet the minimum value test, well, folks, then your employees can migrate over to the exchange, drop your coverage, and purchase coverage on the exchange. That may expose you to penalties. And that's the other thing that you've got to think through is to what extent might you face a penalty? Again, penalties are only applicable to employers with 50 or more full-time equivalents, and those penalties kick in 2015. So as you assess those options, you've really got the choice of continuing your plan, dropping your plan and migrating people to the exchange, or maybe just something in the middle of changing your employee contribution so that you make it such that your employees can really enroll. The future of employer coverage is certainly in question. It's not only probably with all of your industries, but for all employers who are looking at this, figuring out what they should do. What we expect is that there'll be a number of employers who say, you know what? My employees would do better in the exchange. They may get more comprehensive coverage with lower deductibles at lower cost to them once you net the effect of the premium tax credits. In those situations, then the employers may decide to drop coverage, and if they do, they could instead compensate employees by grossing up their wages, increasing their 401k contributions, or providing free vision or dental coverage. Any number of options are there, and you'll absolutely want to talk to a benefits professional, some of whom are right on the panel that you can speak to directly with today. But I mentioned the penalties too. Those employers that have 50 or more full-time equivalent employees will have to factor that into their decision making. If you do have more than 50 full-time equivalent employees, you may face a penalty if you don't offer your employees the opportunity to enroll in affordable coverage. We'll talk during the panel about which of those choices is righteous, and those questions are really going to depend on the circumstances that you have. Now, this panel is only going to get us started on some of the big questions that we all face, and like with everyone here, I wanted to share my contact information. I hope that you'll be in touch if you have questions even beyond this session. If you're like me, as soon as you hit that exit sign, you'll have the epiphany of the thing that you wish you'd ask. Please don't hesitate and stay in touch. Do be in touch with me, as with anybody on this panel. So with that, thank you for giving me the opportunity to introduce this and sort of level set with a couple of key concepts. Again, you have the materials here summarized for you, and we'll look forward to continuing the discussion on the panel. Thank you.
Thank you, Brian. So we are going to go to questions of the audience later on in the program, so please be thinking of questions for our panel of experts. But to get us started, I want to introduce the rest of the panelists who are with us today. So in addition to Brian Hale, we have Susan Hurd, Vice President of the Paradigm Group, Tom Lee, member of Frost Brown Todd, and Alex Tolbert, founder of Bernard Health. And hopefully you've got our agenda card with our faux bios on the back. But I want to start with Alex. Alex, tell us a bit about Bernard Health's role in this space and what you believe employers should be thinking about right now.
Bernard Health and me, so I started Bernard Health. Our company operates 3 business units. The most visible part of our company is our retail advisory business unit, where we operate healthcare retail stores similar to Jackson Hewitt, but instead of being for taxes, for health insurance, Medicare, help people with medical bills, and the like. The second business unit is employer advisory, where we advise employers on their health plan strategy. And then the third is software or web services, where our foundational product, Bernie Portal, is a web-based benefits administration platform to help employers and their employees administer all of their health benefits online. We see, let me ask another question. First to the employees. If you knew you could get health insurance coverage, not be declined as an individual, and that would be the same cost or less than what the group coverage you have costs now, and your employees are going to be reimbursing you, as Brian mentioned, to help you pay for that individual coverage, given that as an alternative, or having your employer pick your plan for you every year, how many of you would prefer to get your own health insurance? Okay? And then there'd be some people who'd want to still get it through their employer. I could also ask the employers, although we talked to a lot of employers, so I know the answer to this, how many would prefer not to have to deal with group health insurance if they knew their employees would be covered? At Bernard Health, we view our role as helping the system get down that path. So here we are in this place where we all have employer-based coverage. Most of us would like to be at a place where we're able to have our own health insurance, but how do we get from there to where we want to go? And that's where we come in. So as an employer, we would help you evaluate dropping your group plan, migrating all of your employees to individual coverage on the strength of our healthcare retail stores, and administering a reimbursement program with Bernie Portal, our software. So that's our place.
So Susan, how does Paradigm Group help employers navigate the Affordable Care Act, and what sort of global advice would you give this group today?
Well, good afternoon. Thanks, Mark. Just to give you some context, Paradigm Group specializes in employee benefits, HR consulting, and retirement services. We're a Nashville company. Our office is over near Music Row in Roundabout Plaza. And we function as advocate and guide to employers of all sizes. Most are headquartered in Middle Tennessee. Many of our clients have employees spread across the 50 states. We have been talking about healthcare reform since 2010. We kind of look back and forget that this has been an ongoing conversation, practically a consuming one, for a number of years. In the early days, we mostly worked with our client employers to help them grasp the concepts, and in the very early days, there were a lot of compliance and notice and other considerations that had to be met immediately. We had kind of a quiet period in 2012, mostly, I think, because everyone was waiting to see what the Supreme Court would say. This year, in 2013, the conversation is really heated up in anticipation of 2014, which we know now for large employers has been pushed back to 2015. Now, the way we have supported our employer clients, we've done lots of workshops and webinars. We've made a point of sitting down with each one of our employer clients, separate from any of our other conversations, to specifically talk about what healthcare reform means to them in their specific situations. For our larger groups, those that are applicable large employers, that is, they have 50 or more full-time equivalents, we have used a pretty powerful financial model to help them understand what it would look like if they took their current benefits and carried it forward to 2015 now, what it would look like if they offered the minimum value, which is a 60% actuarial value, to their employees, which we find is much lower than what most of our employers are offering. Most of our employers are at the silver or gold level, and we'll probably talk about that a little bit more as we go. This financial model will model based on the employer's actual data, their actual head count, their actual rates for their plans and their actual plan design, what the outcome will be if they simply dropped employer coverage. It takes into account the tax effect. And what the effect will be if they need to consider total compensation and compensate for the cost shift that they're affecting to their employees if they were to drop plans and send that to the exchange or to the private market. And I will say that of all the modeling we've looked at, in only 2 situations did it prove to be advantageous for the employer to pay the penalty over sponsoring a plan. And those were 2 employers who have a large number of hourly employees who currently are not eligible for benefits. So it makes a lot more sense not to start something that they had not done in the past. So that was the big topic of conversation this year with our larger employers, not taking into account the extremely technical aspects of even figuring out if you're a large employer and how do you manage employees that vary around that 30-hour-a-week threshold to be eligible for benefits. For our smaller employers, we have facilitated many of them to take an early renewal instead of renewing in 2014, where we were expecting extremely large increases in the range of 30 to 40% for a combination of reasons. We've facilitated their taking a renewal early in 2013, thus avoiding those large increases. I should say postponing, not avoiding.
So Tom, how have you advised clients in this environment, and what kind of legal issues should businesses be thinking about right now?
Thanks, Mark. I do want to take a small point of exception to something you said earlier about setting the politics aside in this way, not in the partisan way that we have had this discussion, but in the way that requires, I think, a smart business person to take politics into consideration. This law is the product of politics. What happens in the future with this law, with regulations, with implementation is a product of politics, or as we've seen, IT consulting. The politics are inseparable because it's public policy. So I want to encourage you to keep an eye on politics, and to your question, that's a big piece of the advice that we give. First of all, this is not legal advice. You're not my clients, except to the extent that you are, and please don't rely on this in any way without having an attorney-client relationship. Having said that, you would not be getting different comments from what we are advising a number of our clients if I said to you it's a good idea to be cautious. And not because we think tomorrow's the day that the Affordable Care Act is going to be repealed or replaced or defunded. I mean, we have kind of worked through that process, and however your politics on a partisan level may play out, we have kind of worked through that process. And now we're in this sort of halting, unsatisfying stage of implementation. I want to suggest to you that the unsatisfying and halting stage is going to continue for a while. And I want to suggest further to you that there are a number of pieces of the Affordable Care Act that are likely to evolve, whether through regulation, whether through remarkables of remarkables, an act of Congress that everybody can agree upon and the president can sign, whether through court decisions. I think the particulars are going to continue to evolve. So what does that mean? You came because you want to help think through decisions that you're facing right now or that you think you're facing sometime in the future. Well, I think what that means is you should be serious about those decisions. You should think carefully about them, but you should think about them in the context that got you to this room in the first place. If you're an employer and you're thinking about, should I push everybody into the exchange? Should I keep what I have? I think it's worth thinking about, how did you come to offer employee health insurance in the first place? Why do you offer ESI? It's not because, well, it might be because you're kind and generous people. It might be because you just think that it's right for people to have coverage and you're the only hope that they have, but probably not. Probably you did it because you want to be competitive in your business, and your competitors offer it. Or it may be because you have a concern for an engaged and alert and aware and present and productive workforce. It may be because you're trying to attract and retain people in a competitive labor market. Now, those are all reasons that have very little to do with the math calculus that the ACA invites you to make. I'm not disregarding the math calculus. That's critical. I mean, you are in business and you know what a spreadsheet is and how it can drive and in many cases ought drive what you do. But you also are in business to do a number of things, and generating spreadsheets for their own sake is probably not one of them. You know how expensive it is to attract and retain good people. You know that that's the thing that drives your business. And so the question you're going to have to ask at some point is this question of, am I going to make decisions that are going to change the nature of the benefits that I offer? And I would suggest, and then I'll shut up and we'll move forward into the conversation further. I would just say that as you make those decisions on a spreadsheet, be cautious. For example, you're going to calculate, if you have more than 50 employees, what the penalty is that you're likely to pay per employee if you drop the coverage that you offer them now and provide them some assistance perhaps to move on to the exchanges. I suspect very few of you are going to go, whoa, this is not my chance. Because you are in competitive labor markets. You are wanting to attract and retain the people that you have. And if you said to them, you know what, I'm out, you're able to proceed on your own, you're going to find that some of your employees are also out. Because there will be other employers that you're competing with who they may drop their coverage too, but they may also be incentivized to add some money back into that salary to make that compensation decision revenue neutral, or perhaps better said, value neutral, if not revenue neutral, to give your employees flexibility, but also not damage them in the process and damage your ability to keep them. Well, those penalties, they aren't carved in stone. And they're as flexible as any other part of this law. And so just approach that spreadsheet with a little bit of discomfort, and here's why. The act, remember, was scored by the Congressional Budget Office to be not just revenue neutral, but actually revenue positive. Well, a piece of that is the penalties. If other pieces of the act don't turn out to generate the revenue that Congress thinks, now I know it's a rare instance that Congress is ever wrong, but if the Congressional Budget Office proved to be wrong in this instance, what's the incentive, either for Congress or perhaps even through a regulatory route? The incentive is going to be to raise the fines, raise the penalties. And then that spreadsheet calculation that you made in 2014 could look very, very different by 2015 or 2016. So, I would say urge caution. Lawyers are tempted to get you to change things because we want you to respond right now to the developments that are in front of you. But sometimes, as a friend of mine likes to remind me, the best option is to do nothing. I wouldn't say do nothing, but I would say it ought to be on your list of options, and it ought to be thought about in the way and for the reasons you got into the business of providing ESI in the first place.
Point well taken. So, Brian, I've heard you say this before, that Baptists fare better under the Affordable Care Act than Methodists. Could you walk us through that analogy?
Boy, they do, and this is just to sort of amplify a little bit of what Tom's saying. You can't look at it in terms of just a spreadsheet, and so to use to pivot to a religious metaphor, I think is appropriate, just to illustrate how the spreadsheet works, but then why you might want to step back. The spreadsheet works for Baptists better than Methodists because Methodists typically buy their health insurance on a conference-wide basis, not all the time, but in many churches they do. The same is true for the Catholic Church. But as in sort of contrast to that, you've got Baptists where the deacon board will buy a small group policy oftentimes to take care of the employees, the organist, the director of education, the preschool director and such. but it's usually a pretty small group of folks. The same is true for Jewish synagogues. So when you think about who's an employer that has the flexibility to really move off of that and discontinue coverage, well, that's really the Baptist church or the Jewish synagogue as opposed to the Methodist church and the Catholics, because they have a much larger paying infrastructure. The key to that, though, is that those employers, the Baptists and the Jewish synagogues, are uniquely positioned because they're very unlikely to have more than 50 full-time equivalent employees. As such, they won't face a penalty. The calculations are different there. The key point there is, well, what does that look like in terms of total compensation? If you drop coverage for the organist, what then happens? Because is your organist going to walk? And the answer may be no. The answer may be you can increase compensation for your organist, again, 401k, vision and dental. You can have, pay Jackson Hewitt to do their taxes, whatever you'd like to do. We'll be happy to help. But the key point there is that it may be advantageous. May not be, but you have to do the number. You have to look at the numbers and then look at it in the broader context of what is your mission with regard to your employees. Is it to maximize their compensation and welfare? Is it to handle a very specific issue? Is it to provide stability and surety and security? You got to match up what you're doing with the mission that you have. And I think, to Tom's point, it absolutely goes beyond a simple spreadsheet calculation. If you walked into the Board of Deacons and you said, I want to discontinue health care coverage, they're going to ask a lot of questions, and they should. That's their job. So being able to have that conversation about what is our mission and then how does this match up to that, or does it, as with the options that you're considering, is really a key point. So it's not just partisan. I mean, it's sectarian too, I suppose, in terms of the ACA. But it's not. It's to say it's complicated for everybody. It's just different levels of complexity depending on where you spend your Sunday or Saturday morning in the pew.
That's not all where I thought you were going with that.
Aim to surprise.
So I'll invite each of the panelists to sort of chime in, but I'll start with Alex on this one. How should an employer decide whether individual plans for employees will be better than group plans?
Well, and I'll start by just sharing, the best panels have different perspectives, right? So you're going to hear a different perspective from me on this. I think your business or your organization and its future health and potential to grow absolutely requires that this be looked at as a financial decision. Furthermore, when you think about why do we offer health benefits, I'd offer a different perspective there also. And to do that, let's just think about it from the perspective of an employer that say that the employee-only premium is $450 a month. And they're paying 100% of the employee-only premium at $450 a month. And that's pretty close to the average across the United States. It's not exactly, but pretty close. So almost over $5,000 a year. How is it that all of us, as small employers, decided that the way to attract and retain and do all those wonderful things that Tom mentioned, the way to get those employees and to win their hearts and minds was to offer them group health insurance? How did we get there? Does anyone know? I mean, you could hire a full-time masseuse and give weekly massages. And if you've got 30 employees, it would cost you a lot less to do that to offer group health insurance. Why are you all offering group health insurance?
Now you're talking about the wellness programs. Be careful.
Right. Well, you're doing it because of taxes.
Yes.
And it actually dates all the way back to 1942 as to why you're offering group health insurance. It has nothing to do with wanting to attract and retain clients. I mean, it's turned into that a little bit, but it's really taxes that put us on this path. And we forget, it was 1942, and then the 1954 tax code solidified that employers could give group health insurance to employees tax-free. Employees could pay their portion tax-free, and that's why we all offer group health insurance. Now, there's another reason that you offer group health insurance. It's a really good one, and that is that there's like this moral imperative. Because if you don't offer group health insurance, some of your people could get declined for coverage, and they could have things excluded. Now, so what did healthcare reform do? Well, first, it made it so individual coverage is a guaranteed issue. You can't be declined. So the moral imperative is gone. So then the second question is, well, what about taxes, right? How has that changed? Well, as Brian would tell you, healthcare reform it's a tax law. And what the government did, there are some policy makers who would have said that the best thing to do would be to get rid of this tax benefit related to group health insurance. But can you imagine the political outcry if the government had tried to pull that back? That was politically very difficult to do. What's happened instead is that they created, when I say they, the government has created a tax incentive for individual health insurance that in a lot of ways is a lot more powerful than the tax incentive for employer-based coverage. And who is it more powerful for? It's more powerful for your lowest paid people. Your highest paid people got the best tax benefit for the last 60 or 70 years, right? Because marginal tax rates, employer-based coverage was a better tax benefit for them than for lower, wage employees. And so some people right now may say, this is unfair because the tax benefit now is better for lower wage employees in the individual market, right? But the high wage earners got a better deal for the last 60 years, so maybe the lower wage employees will get a better deal for the next 60, okay? So taking all this together, you offer health benefits as a way to optimize saving on taxes. Historically, the way to save on taxes was group health insurance. Now the way to optimize your tax strategy is individual health insurance. So there's no more moral imperative. The tax code has changed. Now, there are some questions about whether there'll be penalties for groups over 50 employees. They already pushed those penalties back a year. If they push them back another year, it's hard to envision being the president that wants to be like, all right, now it's my turn. I want to put in the penalties, right? But if you have less than 50 employees, you don't even have to think about that. There are no penalties. There's no threat of penalties. There's never been talk about penalties. Now, in 10 years, could they say that there are penalties? Yeah. And if they change the tax code again, then maybe you'll need to go back to a group plan. But for now and for the foreseeable future, the tax reasons to have a group plan have changed. It's better for most of your people to have individual coverage. There's no reason to feel morally have that moral imperative that you have to offer group health insurance. And then when you look at the options available in the individual market, there are a lot more than there are in the group market. Blue Cross has, for example, in Nashville, created Network E in partnership with St. Thomas. Network E is a lot less expensive than Network S and Network P. You can't get it in the group market. You can only get it as an individual. So if you're an employer and you're thinking, well, I'm doing well by my employees to keep a group plan, you're disqualifying the lower wage employees from subsidies. You're keeping them from being able to get Blue Cross's Network E. And you're not doing them any favors as far as making it so they can get coverage, because they can all get coverage without you anyway with the new law. The big question is, how do we explain all this to our employees? How do we help them make that transition? Which happens to be exactly what Bernard Health does. And so how should companies look at that? They should call us and we'll help them figure it out.
Anybody want to jump on that or disagree? Or?
No, I'll just say that the tax reasons for doing what one does are incredibly important. And I think what some employers want to do, the ones who have come to us, will say something like this: well, I'm paying X per employee per month for a premium, and I could save that money if the employee went out over here, and maybe I'd chip in a little something extra. But you can't make that decision without thinking about the tax consequences. When you make that tax decision, your taxes will go up, and it's just a question of whether where and how do you spend your money, right? If you're getting a deduction right now, and you are, for the premiums that you're paying for your employees, you'll expose that income to taxes if you take that money and either put it in your pocket or pay it to your employees in the form of higher salaries or reinvest it into your plant. I mean, you may be able to find other ways to keep that money from taxation, but by and large, you're going to expose it to taxes, federal income taxes anyway, when you don't use that money anymore for paying premiums. So I agree with Alex completely on this. And of course, 1942 is not for nothing either. It was because of the number of women who were in the workforce that suddenly employers realized, oh my goodness, if I'm going to attract these people to come work for me, I've got to offer these insurance policies, and the way we'll do that is we'll incentivize. I think the most interesting thing about the ACA is that Congress chose not to attack the tax benefits of group insurance. It, in many ways, created an individual market, but preserved a lot of incentives for employers to still think about the group market. I mean, Alex is right. If that had gone away, whoosh, there would have been this rush to the doors. But it didn't go away. It didn't go away. The only other thing I'd say about this is, remember who really, really lobbied in favor of this bill. And by this bill, I mean the Affordable Care Act, Obamacare. Primarily led by the insurance companies. If the last 50 years have taught us anything, it's this, that healthcare policy in the 1960s is driven by providers. And so we passed Hilberton to build hospitals. We passed Medicare and Medicaid to compensate providers. Big, big shifts in public dollars. Those days are gone. Now the political strength is on the side of the payers. If you think about the politics again of Obamacare, you have to think about it that way. I would encourage you not to think about it in a DR way, because that doesn't help you plan your business. I would encourage you to think about it in a provider-payer, and your purchasers in all of this. It's also a pro-purchaser. I would submit a pro-purchaser act. It creates purchasers. For a long time, the purchasers have just been you all. But as Alex said, now the purchasers are individuals too. And who knows what they'll buy. I mean, we've never had tens of millions of people on the individual market the way we're about to have. And it'll be fascinating to see where they go, what they want.
Do we have time for a couple more comments?
Yeah, go ahead.
Okay, I have actually 3 points. One is that health insurance has become, or initially was a differentiator, and I think as Alice pointed out, there can be any number of differentiators. That's the whole point of offering benefits at this point. Currently, though, if you don't offer group insurance, that's a negative differentiator. So that's the environment we're in now, and if we're to go to the individual market, we'll have to deal with that. The other point I'd like to make is that there hasn't been any mention of the negative tax effect on the employees who don't qualify for a subsidy. Those employees are going to lose that 100% subsidy that for individuals that their employer was giving them, plus they're going to lose the ability to pre-tax their premiums. So they're going to lose that amount of tax there. So to a large extent, depending on how it's constructed, the moving employees to an individual scenario is a cost shift to employees. And once again, employees will quickly realize that. They always do the math before you do, almost. If you've got a cost shift, it can't be in a vacuum. It's going to have to be made up somewhere else. So you have to take into account not only your tax savings, but the cost shift to the employees and what that means to you in terms of what you have to do to make up the difference and continue to differentiate your business.
So I was going to ask Susan you this question. So you still get businesses who are confused and just don't even know if they have to offer coverage. What do you advise them? And then tell us about the 60% rule and what that means.
Okay, that's 2 questions. In the largest sense, nobody has to offer health insurance. You know, there's no law that says you have to offer health insurance, and that's always been the case. In 2015, if you're a large employer, you still don't have to offer health insurance, but you'll have a penalty if you don't. Small employers do not have to offer health insurance, and that has not changed. So I think that in all of our discussions, it's important to remember that the calculus is different depending on the group size that you're your employer-sponsored plan would be. With regard to the 60%, and I have to say that was not one of our clients that asked us that, because I can't imagine that one of them would have that confusion, but there's a couple of things. The question was, does the 60% number mean that I, as an employer, have to pay 60% of the premium in a group-sponsored plan? And the answer is no, that's not what that means at all. Now, health insurance companies typically have had a minimum contribution that they require before they write the policy, and that's typically been 50%. And if you shop for insurance, you know that you're required to contribute at least 50% of the premium. Just in recent days, Blue Cross has changed their policy on that for small employers, and it remains to be seen what effect that will have. If you're a large employer, that's the minimum value coverage that you have to offer in order to avoid a premium. The other thing is that the plan has to be affordable. But just talking about actuarial value right now, that is a general look at a specific plan design, and overall, on average, it's expected to pay for 60% of covered charges. So overall, on average, and it doesn't work out this way on an individual, but a specific plan design will pay 60% of the charges that are incurred by the employee. Now, we talked about the metal, I mentioned silver and gold plans. On the exchanges, the government has decided it's a good idea not to use terms like actuarial value. So they have deemed the various levels of actuarial value by so-called metal terms. A 60% actuarial value plan on the exchange is a bronze plan. And you may also have employees that are kind of keyed into the metal values. That's why we've made a point of informing our employees and employers what the actuarial value of their plans are. There's a calculator that you can do that with. Most of our employer plans have a silver actuarial value, which would be 70%, gold would be 80%, and platinum would be 90%. And as you can guess, and probably have experienced, the actuarial value of the plan has a direct impact on what the premium will be.
So we've talked about taxes, and we've now talked about the exchanges. Brian, can you talk about the tax season and how it affects the insurance exchanges?
Absolutely. And first of all, how many people in here are lucky enough to get a tax refund? Okay, clearly you're not getting your taxes done at Jackson Hewitt. Talk to me afterwards, get your coupon, we'll get that fixed up. But that actually makes you quite, the response is a little bit anomalous, because three out of 4 Americans get a tax refund each year. And in fact, that tax refund is critically important to their consumption patterns for the course of the year, because most consumption in the first quarter is paid for out of their tax refund. There's a reason why Walmart sells more tires during February than any other time in the year. There's a reason why Walmart also likes Jackson Hewitt to be in 2,700 of its stores. There's a reason why they want that tax refund delivered to that particular retail location. The best thing you can have is a person with a check for $3,400 sitting right there in the store looking to spend it. So the question then becomes, when does someone enroll in health coverage? And one of the things that I think we really have to look at this is that while the administration talks about disappointing enrollment numbers because of the sort of biblical nature of the debacle with healthcare.gov, that's almost a sideshow. Even if healthcare.gov had been functioning correctly, we wouldn't have seen very large enrollment in the healthcare plans in the fourth quarter, and that's because most Americans that would be eligible for the tax credits don't have the cash to pay the premiums during that part of the year. They're focused on what can I put under the tree, not what can I do in terms of putting a health insurance card in my wallet, especially if they've been uninsured for the last 2 years. So what we at Jackson Hewitt have been trying to do is explain and sort of evangelize on this point. Sell insurance when people have the cash to buy it. Match what you're selling to what your consumer can actually afford to pay. And the real sweet spot to sell insurance is in February and March, when the IRS is sending out billions of dollars in tax refunds. Here's the statistic: 41 million Americans filed taxes in the last 3 weeks of the tax season between the end of March and April 15th. The IRS sends out $36 billion in refunds just during that 3-week period. $36 billion. So the real question is not only sort of whether you as a business are doing this, and when are you as a business trying to decide how to help your employees, and that's a huge decision, and that's right now. But the flip of that decision is, let's say that your employees are displaced, you're not offering health care coverage. Well, making sure that they connect with someone who can advise them on how to do it, but is keyed into their financial calendar. And that financial calendar is going to be driven by the timing of their refund. Now, I harp on this because the IRS has postponed the tax filing season. Some of you are like, well, who cares? I only file April 15th, and they're not going to postpone that. You're right, they're not. The key point, though, is that so many millions of Americans are outside our doors in early January trying to file their taxes because they want that refund check. And they want that refund check because it's the earned income tax credit, the additional child tax credit, the withholding the over withholding, all of that stuff. So if the IRS punts that down the calendar a little bit and they delay sending out refunds by 2 weeks, boy howdy, is that going to affect consumption and affect enrollment. Now the problem with that is the federal government really hasn't tied that together, that liquidity event, that injection of cash flow, with their signups. And so until that happens, we probably won't see signups in more than really, really suboptimal levels. And as much as we want to say it's really healthcare.gov that's been that explains what's happened, it's not a surprise. Even if healthcare.gov had been working perfectly, it probably wouldn't be that much better, because you can't pay for something when your wallet's empty. You just can't. No matter how much you want it, it ain't there. And so we've got to really work with customers and figure out how do we help them. And that's why Jackson Hewitt has made such an investment in this area, because we know customers do want this. And so how do we take an extra 5 minutes at the end of a tax interview, help them enroll in coverage, because it's all it really takes is 5 extra minutes once you've done a very long tax interview, and then work with someone to pick the plan, knowing that you're going to have a refund of exactly what we tell you it's going to be. That's why you're going to get your taxes in at Jackson Hewitt, exactly why that amount, so you know whether or not you can afford to pay that premium.
Interesting point. So we're going to take questions from the audience, so get those ready. But let me throw one question to the entire panel, if y'all will jump in on this. Should an employer consider moving employees from full-time to part-time status to avoid the penalties?
Okay. That sounds like a lawyer question. The answer is it depends.
Lawyer answer. That's pretty
Throw me one across the plate, I'll throw a curve. That's actually a common question, and it's one that's worth asking, and it's going to vary inside your company. So issue one is the tax considerations that Alex has identified. Issue two, you're going to think about, are you creating a two-tiered benefit system within your company by so doing that? Are you disrupting something that may go to the way your employees see you as a fair and equitable employer, which keeps them around? If so, there may be some numbers that work for you in that regard. I mean, if you can hold that together, there may be some numbers that work for you in that regard. It's going to work, I think, differently in different workplaces. What we expect is a workplace that has a predominantly low-wage employee base, hospitality, food and beverage, retail, or a very seasonal workforce, tourism. We think you'll see a lot of this, actually. And some of you may be already doing that. Who in here is in the food and beverage business? Restaurant, hospitality, some, right? So I think the incentives for low-wage employees are going to run more toward that kind of change in status, and it makes some sense. High-wage employees, that's going to be a challenge. I mean, who's going to say to the CFO, you're now a part-time CFO? Or to drop it down a little bit further, who's going to say to the legal assistant in a law firm, you were working 40 hours a week and getting health insurance that we were paying 60, 70, 80% of the premium on. Now you're a part-time employee, and you'll get zero, when the person who's got the office just across the hall that looks out the window is still enjoying the benefits of full-time employment and a nice insurance plan. So you're going to have to think about both. And I would suggest that the math and the workplace issues will vary according to the competitiveness of the labor market in which you're in.
All right, so we've got a few.
Thank you for nodding, by the way.
I do have a comment on that,
Sure.
as on pretty much everything. We've spoken with a lot of employers about this issue, and first of all, most employers define a full-time employee as either 40, 36, 34, or 32. So it's not really the full-time employees that we're talking about, it's the ones that typically work 28, 32, around in that area. And it is typically going to be in hospitality, in hospitals where they have a lot of PRN staff, in food and beverage. What we're finding is two things. One is that if you decide to cut your staff, say your people that were working 32 hours, if you cut them to 28 hours, you're going to have to manage that very carefully. And there are extremely complicated rules about how you determine eligibility for employees whose hours vary around 30. And I have told everybody, don't go there. Right. But it's the nature of some industries that you have to. The second issue is that you may, let's see, I had a note here. Oh, if you think about warm bodies, when you cut hours, you need more people. You need more warm bodies just to take up the slack in your staffing. And right now in Nashville, we've got a real labor shortage of people to work at the new convention center, at all of the new restaurants. So it may not be a good strategy to cut hours because those people can go anywhere. And if you cut hours, you're going to just need more people to get the job done. So it's not just a question of avoiding the penalty. It's got a few other aspects depending on what industry you're in.
And I apologize, but Susan makes a great point that I think I want to amplify just one bit. You know that for purposes of, for example, the Fair Labor Standards Act and determining whether or not people are entitled to overtime, that's just an example of a paradigm that the government policy tends to favor a finding that people deserve more than perhaps you think they do. Here's why that's important here. Suppose you had a business, and I'm not attempting to see into the books of your business, but let's suppose you knew of a business where, because of your budget constraints, you could only bring on so many FTEs. And the way you dealt with that is you had some part-time employees. And suppose those part-time employees are really working 30, 32, 36 hours a week just because you need them to work that much time. Those aren't part-time employees for purposes of this law. At least you should not expect that they will be so found. You should expect that the government is likely to take an attitude that, oh, no, those are full-time employees. So Susan's exactly right. If you're going to cut someone from 40 to 20, that's one thing. But if your goal is, or your thinking is, well, I'll just pare back 8 hours, and that won't be that much, and I'll spread it out over a number of people, but it turns out those people are actually working a little more, and that's not uncommon, especially in large employment situations. Just be careful about who's part-time, who you think of as part-time, and who an auditor from the IRS, because Brian's right, Alex is right, this is a tax law, not a healthcare law. This is a tax law. And the people you're going to be dealing with are not healthcare auditors, they're IRS auditors. And you know the approach they take.
Great point. So let's go to a question or two from the audience. If you would raise your hand if you have a question. We have a wireless mic that's making its way. So we have a question in the back.
Yes, thank you. Our company has slightly less than 50 FTEs right now and will likely transition over the next couple of years above the mark. So a couple aspects. One is what happens in the middle of the year if you transition? And secondly, do you have any advice given the situation we're in and where the company may or may not transition over 50?
Well, your status as an applicable large employer is determined on a one-year look back. So what you are on 1/1/15 depends on what you were in 2014. So, which is another thing, you've got now a year to think about any changes you might have to make that would affect your status. To your second question, if your status changes mid-year, you're frozen in your status for a full calendar year. So everything won't radically change for you, but it may the next year. And I guess in terms of a company that may be growing, that generally is a really good thing. And I would think that you would not let healthcare reform drive your business strategy from that standpoint.
All right, another question from the audience? Yes, we're here in the middle.
My question is, as I looked through all the different information, it looked as a tax preparer, when I'm preparing the W-2s for my employer's employees, I'm going to have to include what was the premium-only deduction, turn around and add that into their wages. Did I read that?
Right, no.
I know that the FSA deductions have gone away. As far as the flexible spending accounts and so forth, they've been limited this year, but in the future years, you're not going to be able to take advantage of the flexible spending accounts.
No.
But I also, for the employer's portion, the benefit that you receive for your group health, I also thought I saw where that had to be added back into the W-2 wages.
Yeah, and I think just two very quick tax points. The first of it, the FSA, the flexible spending accounts are not going away, but there are new restrictions about both on that and on the excess medical deduction that you can take. And I love saying this. I almost sound like a tax guy, even though I almost failed tax in law school. So take it for what it's worth. I'm the healthcare guy at Jackson Hewitt, not the tax guy. But the second point that you're raising is about the W-2 reporting for the issues around healthcare. You do have to report the value of the premium, but you do that, I think it's in box 12, DD, and in that, so you should know, thank goodness someone who knows more than I do is nodding their head.
Yeah, currently it's in box 12 as a DD code, but what I've also read is that in 2014, it moves from box 12.
No, it doesn't. The only time you would ever have a tax liability for what shows up in box 12 is if you're subject to the Cadillac tax, which is a very different calculation that the employer would make, and it wouldn't be based on the W-2. There are separate reporting issues, and they're called the 6055 reporting and the 6056, named after the section in the Internal Revenue Code that the ACA amended. And those have to deal with what the employer reports in terms of the value of the coverage that they offer, and to whom do they make that offer of coverage. That's a 6055. The 6056 is what the insurers report. All of those reporting requirements were delayed. Number one, they don't affect the W-2 directly, and they certainly don't affect the W-2 for 2014. They will the IRS will issue guidance on the 6055 and 56, but they won't do that until probably April of next year. Where I think there's been a lot of confusion, and I think maybe the source of your question is the IRS put out a notice, I believe in August of this year, saying that you would be able to use your W-2 in order to do your 6055 reporting, and they talked about how you'd have to move things around in order to comply. Suffice it to say that guidance was complex. It is not final, and it probably will not be finalized at all. They're going to entirely rework it. So if you're thinking about that notice that came out in August, I would just put that in the back of your mind, because they've acknowledged they're going to have to completely rework that.
We had one question on the far end over here.
I have to represent this side of the room. I'm Phyllis Shelton, LTC Consultants. I've had about 35 years of experience in healthcare looking at the whole picture. So I want to bring you back to where you were talking about vision, dental, contributing to 401k options besides group health insurance. It would seem to me 55 and up is the fastest growing part of our employee workforce. Half of the people are women. We're looking at a caregiving crisis in the next 20 years. Employees are going to be dropping out of work, men as well as women, to be caregivers. So it looks like to me the thing to do would be to offer long-term care insurance, pay for it on the employee. It's completely deductible for the employer. It's tax-free to the employee. That frees up dollars to buy it on the spouse, so the employee doesn't have to quit if the spouse has a stroke, and parents and other family members are eligible. Wouldn't that be the most meaningful thing, because it's productivity insurance for the employer, and the employees are asking for it all day long?
I know others will have, just to chime in, I think you're right, and in the perfect world where you're redirecting compensation in sort of a tax efficient and in an optimal way, that's what you probably would do. The problem is that employers are significantly under contributing to 401ks and not contributing at all often to dental and vision, which are the most popular benefit plans that employees get. So part of this is responding to the perceived value of benefit of dental and vision. Whether or not they have actual value or objective value is a different question, but subjectively they're very important to employees. And the other one is just moving something towards savings. I think you're exactly right about the value of long-term care insurance, but when we look at the take-up rate of long-term care insurance, even among employees who have very well subsidized health insurance, it's very low. And so, again, great idea, it's just hard to sell the public on the benefit of it, and probably an easier sell would be the 401k, but your points are well taken.
Yeah.
Please join me in thanking our panelists this afternoon.